Market's going to crash. Papa Power crashed the market. Inflation's going to be terrible. What's this? Producer prices rise nearly double than expected? Holy flippity flip flop flapping smokes, everyone! Just when people thought we're finally in a huge market rally and there was nothing that could stop it, while we just got some huge economic data today, and people, this report was a complete disaster. Because I've been getting a lot of comments lately.
Michael, you're a perma bear. You're a broken clock.
No, people, it's just that I do something what you should really do is called critical thinking. Just because the market's going up and it goes up for a month doesn't mean it's time to buy. Doesn't mean that the bear market's over. It doesn't mean we're in a full-on bull market and we're going to all-time highs. And there's something called irrational exuberance. That's where the market can be irrational and the market can simply just rally for no reason whatsoever. Maybe the machines are buying, the algorithms are buying, Wall Street wants to bring some suckers in to try to regain some of their losses after they lost huge amounts of money in 2022, and they need some sucker retail investors to dump on. Because right now, as I'm recording this, it's about 1:30 a.m. here in Australia. I was in bed, wasn't planning to do a video, but when I saw this report come out and how bad it was, I literally jumped out of the bed, ran to the studio, and now I need to give you this report. So if you appreciate this breaking news updates and this dedication to me not getting any sleep, please hit that like and subscribe button. Okay, everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Well, holy smokes, everyone, look at this. Wholesale prices rose 0.7% in January, more than expected, fueling inflation increases. Now, the reason why this is so big, because look at this, the market was anticipating only a 0.4% increase. So that's right, this report is nearly double the estimate, and that's why it's so bad. And this is producer prices. So this is actually a leading indicator to say what's going to happen with prices going forward. Because CPI can actually be a lagging indicator. It's showing us what's already gone up, while PPI is telling us what companies are having to pay, what producers are having to pay for items right now, and this is going to be flowed on to the consumer in a matter of months. So the PPI increase came amid a 5% increase in energy costs, but a 1% decline in food, they say. Now, what have I been saying, everyone? I've been saying energy prices are about to rebound, is going to make inflation worse, and we're now starting to get that in the inflation data now, because the reason why the CPI has been falling for the past 3 months is because we saw that huge drop in gas prices, because Biden is manipulating the markets. We don't have a free market for the oil market right now. He's trying to keep it suppressed, but he can't do this forever. And eventually oil and energy costs are going to skyrocket again, and this is going to keep inflation high for longer. The final demand for good index for goods rose 1.2%, the biggest 1 month increase since June. About 1/3 of that increase came from a 6.2 increase in the gasoline index. The service index also rose 0.4%, pushed by 0.6% increases for prices for final demand services, less trade, transportation and warehousing, and another big factor came from a 1.4% increase in the index for hospital patient outcare. So this is an absolute crazy report, everyone, and if you analyze this 0.7% increase, that's actually 8.4% annualized. So this report, combined with the hotter than expected CPI report, combined with the strong jobs report, also combined with the retail sales report, which is very strong, this is telling us there is no reason for the Federal Reserve to pivot anytime soon. There is not going to be any pivot in 2023, and the market is in complete denial by how high interest rates are going to have to go to. People, I now think interest rates could actually go to 7%. I said 5% was a minimum, but with this inflation data coming in hotter than expected, they at least for now need to bring interest rates above the inflation rate. Whether that 6% CPI falls down, or if it doesn't fall down, they're going to have to go to 7%. Because also in other economic data, jobless claims edged lower to 194,000, below the estimate for 200,000. Also, the Philadelphia Fed's manufacturing index plunged to minus 24.3, well below the 7.8 estimate. So what this is telling us, the Federal Reserve is not going to have any excuse at all. We've been seeing a lot of people on Wall Street saying the Fed can't lift interest rates because huge amounts of people are going to be losing jobs. Yes, that will happen eventually, but for right now, unemployment rate is at record lows according to their data, which we all know is manipulated. But according to their data, unemployment is at record lows. Initial jobless claims, they're still at low levels. There is absolutely no excuse the Federal Reserve has for not lifting interest rates. And really what I think has to happen, they have to lift interest rates by 0.5% because Jerome Powell made a very, very dangerous mistake. Because what he said during his last press conference was we are now having disinflation. That's right, people. Even though CPI is still triple the Federal Reserve's mandate at 6.4%, and now we've got this red hot PPI report, he said we have disinflation. And really what I think he did is he jinxed himself. Never doubt the power of a good jinx. So with him saying that, what he caused was a lot of his work that they have done, a lot of their good work they have done was completely undone. We saw financial conditions loosen. When stocks rally, when bond yields fall, that is loosening financial conditions. We're seeing a lot of risk assets right now. They're absolutely skyrocketing. Tesla's skyrocketing. We're seeing a lot of profitless tech companies, or even seeing companies facing bankruptcy. Their stock prices are skyrocketing. We're seeing a lot of cryptocurrencies. They're booming. Bitcoin is up a lot, but there's other meme coins like Floki coin, etc., up 50%. So what this is causing a melt up, and this will lead to higher inflation unless the Federal Reserve humbles himself, bites his word, takes back that disinflation comment, which was very, very dangerous and is going to potentially lead us to now have to go to higher interest rates. He's going to have to bite those words, take them back and say, look, I was wrong. Actually, inflation's much worse than we thought, and we're going to have to do a 50 basis point hike this meeting again and again and again until the inflation rate falls below the federal funds rate. Because again, let's have a quick look at this retail sales report. So retail sales jumped 3% in January, smashing expectations despite inflation increase. Now you may think, well, if retail spending's up, that's good for the economy, that's good for the market. Yes, it actually is good for the economy, is good for the markets in the short term, but what this is ultimately going to lead to now is the Federal Reserve is going to have to lift interest rates even higher, like I said, and keep them high for longer because the economy is a lot more resilient. And for right now, because we haven't felt the full effects of these rate hikes, the economy is holding up, so they can't use the excuse of possibly falling into recession as an excuse to not lift interest rates more. Now, what happened yesterday when we got this report, the market initially sold off, but then we saw a market at the end of the day. But again, people, sometimes you can just have markets that go by momentum. Right now, we got a bit of a bullish momentum right now, or I should say, before this PPI report we did, and they could just rally for literally no reason, or for whatever reason, if the market makers want to melt up or they want the market to rally so they can manipulate the market to try to turn some of their losses into profit. So listen to this. Food services and drinking places surged 7.2% to lead all major categories. Motor vehicles and parts dealers increased 5.9%, while furniture and home furnishing stores saw a rise of 4.4%. Even with a 2.4% increase in gas prices, receipts at service stations were flat. Online retailers saw a rise of 1.3%, while electronics and appliances stores increased 3.5%. And no category saw a decline, falling in December, in which sales fell by 1.1%. Now again, this retail sales report seems good, but actually year over year, retail sales are only up 6.4%. Now, what's the CPI? That's right, 6.4%. So the only reason why retail sales are up is because the cost of goods are up, not because people are buying more goods. It's just that everything's more expensive. Now, the CPI is 6.4%, but we all know the real inflation rate is at least double that, more like 12%, especially according to ShadowStats based on the 1980s model of the way they used to record inflation. So in real terms, I think people are actually spending less. It's just that everything is so much more expensive. Because look at this, everyone. This is absolutely crazy. A dozen eggs now costs more than a pound of ground beef. This is absolutely insane and unsustainable, everyone. But this is because we're seeing the huge amounts of manipulation, what the global elites are doing with the food supply right now. But let's go ahead and see what the market's reaction has been to this report. So look at this, everyone. We can see here, this is the DXY, the dollar index. It's rallied from around 103, and now we can see it's surged to 104. We can also see the 10-year US Treasury yield is rallying as well. It's gone from 3.76% to 3.84%. Now, there's also some other very key factors I think that's going to have huge consequences for the markets, and that is what happens if bond yields, for example, the 2-year goes to a yield of 7%. Well, you're going to have a lot of baby boomers which are retiring right now. they're going to put a lot of their risky stocks and they're going to put it into short-term US treasuries, because the average return for the S&P 500 is anywhere between 9 and 11%. So a lot of retirees simply won't want to risk putting their money in the markets, especially with so much uncertainty right now. They're going to either put them in short-term bonds or simply put it in cash in the bank, because they can actually get some yield on their savings now. And on top of this, the baby boomers, which is the richest generation right now, that are literally retiring as we speak, they're also going to have to sell their stocks to fund their retirement as well. So we're going to see a lot more selling pressure, because the baby boomers are the one that hold the most assets, and we're seeing a lot of the millennials, they simply don't have much money left over with the price of inflation. They don't have much discretionary money left over to invest in the markets right now. So we're going to see a big generational shift with a lot of selling pressure, and I don't think the millennials are going to have enough buying pressure to offset it. Now, just to play devil's advocate here and give the other side of the story, or the bullish side of the story, what could possibly happen, or the reason why this market's rallying right now and what they're hoping for could happen, and something that could cancel the market crash, would be something which would have devastating consequences for the middle class, but it would be good for the stock market. And that is, what could keep this rally going is if the Federal Reserve actually changes their inflation mandate and their inflation goal. For example, if they all of a sudden change their inflation target from 2% to 4%, we would see an absolutely huge rally in the markets. Because if their goal is 4% CPI, well, then we know that their real inflation would actually be 8%. And what that means is they'll drop interest rates, they'll stimulate the markets, they'll print money, and they'll try to convince the people, look, inflation's great because then that means you get a pay rise, we have more economic growth. It's actually a great thing. Well, yes, it's great for the elites and it's great for the 1% who spend the majority of their income on assets, and food, housing, transportation is a very small part of their spending. Yes, it does benefit them, but the poor and the middle class that don't have much assets at all, and the majority of their income is spent on housing, transportation, and food, well, that hurts them the most. But I think this is very, very unlikely, and if the Federal Reserve doesn't do that, like I've warned about, we are still going to see a market crash, everyone. You just have to be patient, because this is going to take time to play out, because we haven't felt the full pain of the Federal Reserve rate hikes. A lot of people think, well, the market hasn't crashed yet, the economy hasn't crashed yet. That's because we haven't hit peak interest rates yet. The Federal Reserve could keep hiking all the way towards the end of the year, and we won't feel the full pain until 6 months after interest rates have actually hit their peak. They've lifted them so fast. This is the fastest hiking cycle in history. We haven't felt the full consequences yet, and we don't know how bad things are going to get. So everyone, you know me, I won't flip just because the market turns green for a couple of weeks. I'll keep giving you the truth, the facts, and the data, and it's up to you to make your own decision what you think is best for your own personal circumstances, if you think now's time to buy or time to sell. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.